So let's check in on the fixed income and currency markets. We've got Phani Shankar, who's head of financial markets at ING Vaishya Bank, joining us from his office. Phani, just to begin with, the current, the big question really is the liquidity crunch that the markets continue to see. On the 15th, what are you expecting from the Reserve Bank of India? Do you expect, like everyone else, is a half percentage point cut in the CRR, or do you believe the RBI may do something even bigger than that?
Hi. Like you rightly said, the big thing on the market's radar is really the liquidity situation. 0.5% is about 30,000 crores, which at this point of time is something that should bring the LAF number from around 1.2 lakh crores right now to about 90,000 crores. So, and you do anything more than 50 basis points, closer to 100, it's 60,000 crores of liquidity infusion, which we feel at this point of time might be a little more than necessary. Also, a CRR cut is not just a liquidity infusion, because it's also seen to a certain extent as a monetary policy signal. And is this also the right time to give out a monetary policy signal of such aggressive nature? So on the balance, it looks more like a 50 basis points rather than 100 basis points.
So in light of this, what is the range that you're foreseeing for the yield on the 10-year bond, Phani?
A lot of this is really factored into the bond yield. Given the data-heavy week that's there next week, we think there might be a little bit of an upside to bond yields. So you could see bond yields pushing towards, the benchmark pushing towards 820 or a little lower than that as well. But it's not a place where there's a huge range that's left for the bond markets. Most of it is factored in. The demand-supply factors are all known. Even what we're talking about, the IIP numbers of 2% or what we expect will be slightly sub 2, doesn't really tilt the growth factors so much that a rate cut or a liquidity situation will have a very benign effect on bond yields. On the upside, we don't see too much on the higher side on bond yields from the current 825, 26 kind of levels that we are. Also because there's a fairly good demand for G-Secs that's there. So on the balance, it's a slightly range-bound scenario with a mild positive bias for bond yields.
Right, and Phani, just looking beyond the current financial year, going into FY13, do you believe on a budget day on the 16th, the FM is likely to announce a borrowing level which is going to look similar to what we are seeing in the current financial year, or do you believe it's going to be higher?
Well, in fact, if anything, we believe it will be marginally lower, at least at the time of announcements. We do think the fiscal deficit number will be well below 5%, and the total gross borrowing number, the net borrowing number we're looking at is about 4 lakh crores, which is lower than what it was this year. There is a risk that this number could slip a little higher as we go by in the year. But the announcement itself is unlikely to be too negative for bond markets, and if our estimate is that it will be slightly lower than where the current market consensus for this is. So at about a 4 lakh crore give or take is where we believe the net market borrowing program for this year is going to be, for next year is going to be.